Good morning and a warm welcome to BVTV. Today's BVTV is going to be a special emerging markets, and in order to talk about bonds and equity, I'm very pleased to have with me an EM equity expert and colleague, Michael Bourke. Michael, welcome. After double-digit returns in 2016, emerging markets have had a strong start since the beginning of the year. There have been fundamental drivers like commodity prices behind the positive momentum, but also, very importantly, the search for yield has been a key driver. On the bond side, many investors have switched to emerging market bonds because they still offer on average a 4.5% yield in hard currency, up to about 6% in local currency sovereign debt. More surprisingly though, EM equities have also benefited from the hunt for yield. Why is this, Michael?
Charles, historically I would say investors have had this lazy assertion that people buy into emerging market equities purely for growth. Over the last 12 months that's been turned on its head with rapid outperformance by valuation and dividend names. Underpinned by recovering improvement in fundamentals and relative attractiveness of valuation and yields on offer, certainly in relation to US 10-year yields at 2.5% and bonds at paltry 25 basis points.
But investing in EM equities for income does not come without risk, right? You have currency risk, capital loss potential. Are there other considerations income investors should be aware of?
Plenty. I mean, unlike bonds, obviously, the cash flows and dividends accruing to an equity investment are not fixed in nature. The emerging market equity universe has a great number of cyclicals and government-owned entities with a much lower commitment to maintain that dividend. So you'll see in our chart here that about a third of EM corporates cut their dividend every year. Relative to that, in developed markets, about the same figure is about 10%, or just lower than 10%. So income investors in EM need to be very careful and selective, judging the sustainability of the income.
Okay, but the fundamental backdrop is more positive, right? If we look on the macro side, if you look at the largest countries in emerging market, Brazil, Russia is likely to return to positive growth. There's less concern about Chinese growth. And maybe apart from Turkey, the overall EM political risk has diminished. All of these being very supportive of emerging markets. On the other hand, political risk in developed markets have become the main risk for emerging markets, with a number of elections in Europe and the uncertainty of the Trump administration. A very good example of that DM contagion into emerging market is Mexico. Consumer confidence in Mexico saw a historic decline of 18% in January, a larger fall than during the global financial crisis, driven by the fear of a revision of NAFTA and the Trump rhetoric on the wall. Looking at the bigger picture, should the US engage into a trade war with China, global trade will definitely be at risk. Is this scenario a source of concern for EM stocks as well?
Yes, I mean, trade protectionism is a risk for global trade, particularly for North Asia and Mexico. That said, over the last 12 months, we've seen improvements in EM, emerging market corporate fundamentals, driven by rising profit margins and lower capital expenditure, sparking a rebound in earnings and returns. Markets have responded accordingly, and we've seen strong returns in energy and materials names particularly. We still see considerable value in financials and technology names in Taiwan and South Korea. Over the long term, stock selection trumps politics and economic and macro concerns for us.
Okay, so I share the positive view on fundamentals, but on the bond side, obviously EM could be affected by the US monetary policy. The market is now pricing in a 90% likelihood of a Fed hike in March following Fed President Dudley's interview last week, as well as Yellen's speech on Friday. Emerging market bonds remain very sensitive to technical factors, and should the Fed turn more hawkish than expected, this would be bad news for EM as a whole. The bottom line is optimistic on EM fundamentals, but cautious on technicals and global monetary policy. So now, here are the things to look at for the week ahead. In Latin America, Brazil's fourth quarter GDP number will be released tomorrow. Will this be an 8th straight negative quarter, resulting in Brazil's worst recession ever? Most economists think so. Going up north in LATAM, Mexico will report February consumer confidence figures, which hopefully a better number than in January. Finally, it will also be busy in Asia, with China and India due to report their trade balance for February, respectively on Wednesday and Thursday. That's it on our side for today. Michael, thank you for joining.
Thank you.
Thanks very much for watching, and have a good week.